All right, we're going to look at a new trade setup. This is a weekly 112 SPX Bear Trap. Last week, we were looking for an expiration with 52 days until expiration. That was not available. 17 February contract was 59 days. So we entered a trade with 59 days until expiration last week. This is the same trade I would have entered today. However, we already have a 17 Feb position on. So what I'm going to do, I'm going to look to set up a trade in a February 10th expiration cycle with 45 days. So obviously this has less days until expiration. Therefore, our out of the money short naked puts are going to be a little bit closer to at the money. S&P is currently trading at 38.25. So what I'm looking for, normally I would go out and I would look for a short put out of the money where I get to collect somewhere around $9 or $10 for it. If we go far enough, 33.50 is currently showing a mid price of about $10.45. If we go the next available strike over, which is 3,300, 50 points further out of the money, this one is showing $8.10. I think I'm going to go with 33.50. So I'm going to sell to open 33.50 put, and I'm going to buy to open a 30-point wide put debit spread. This happens to be 37.30, 3,700. And this trade is currently going for about $11.85 credit. Now, this is a little bit higher than what I normally collect, right? I try to stay somewhere between $9 and $10. Last week, I sold a 112 Bear Trap. I went out a little bit farther out of the money on the puts, and I only took in about $8.50 or $8.75 or something like that. This trade is a little bit closer at the money, so I'm collecting a slightly higher credit, which is the positive, right? It's the benefit. We get a little bit more money up front, but on the flip side of that coin, the negative here is that we are trading a little bit closer to at the money, and our net delta to start is a little bit more positive than if we were to set up the same trade with all options slightly farther out of the money. I think this one is going to do just fine. I have a number of positions that are now carrying negative delta. So I am okay with trading a little bit closer to at the money and starting off a trade with a little bit more positive delta in exchange for slightly higher credit. So you do have to, consider your individual situation if you are following along. For right now, my trade is to buy to open 37.30, 3,700 put debit spread in the February 10th expiration cycle. And for every one put debit spread that I'm buying, I'm going to sell 2 of the 33.50 puts. These are naked and they are in the same expiration cycle. Current mid price for this trade is currently going for about, I'm looking at the mid range. So we're seeing 1165, 1160. We saw 1170 as high as 1180. I'm going to try to get in as close to the midpoint as possible. I'm going to try to collect between $11.50, maybe to as high as $12 credit. Now, as far as management goes, this trade can work one of 3 ways, I guess. The absolute best case scenario where we won't have to make any adjustments is that S&P never comes down below 37.30, which is where our long put of the put debit spread is, and we just get to keep whatever credit we collect up front. Case scenario number 2 is that the price kind of goes up and down, but overall we drift lower and we end up inside of the bear trap at expiration. That is where we get the bonus. Our put debit spread is going to be worth its max value, which is 30 points or $3,000 per one contract. And our out of the money naked puts are going to expire worthless, giving us the absolute best case scenario as far as profit potential goes. We might have to make adjustments if we get inside the trap early on. This trade has 45 days until expiration. So if in the first 30 days we get inside the trap and we start to accumulate positive delta, I'm going to have to look for ways to flatten out my T+0 line so that if the market continues lower, I'm not going to get hammered. As you can see, this one could go and get into some serious trouble relatively quick if we pull back just 10% over the next couple of weeks. And the third scenario is that if we go inside the trap and we go far enough, even with all the adjustments, if we get into the second third of this trap and there's still a lot of time on the clock, maybe I am wrong on my net bullish assumption for this trade, and I will need to step out of this trade. My max potential, this is a 5 lot, so my max potential here is somewhere around $20,000. If I'm going to do my best to manage this trade and keep my net Greeks in check. However, if this trade starts to get out of hand, I definitely don't want to lose 5 times what I stand to make in the best case scenario. So if this trade is down about maybe 1.5 times the trap profit, I'm going to consider cutting this trade and start to focus on other positions that I may be holding at the time. So for right now, this is the trade. We are buying to open 3730, 3700 put debit spread. This put debit spread is going to be financed by a sale of farther out of the money puts naked. 2 puts for every 1 put debit spread. Naked puts are at 3350. This trade is currently going for about $11.50. I'm going to try to get in somewhere around $11.50 to maybe as high as $12 if possible. And I'll post any future adjustments as they come about.